Measuring a business's economic mode is a challenge, but a comparison using several metrics allows us to get an economic mode idea. That comparison is the grudge match of finance, WACC versus ROIC. Before we compare the two metrics, let's look briefly at both sides of the comparison. What is WACC? An overview. WACC is an acronym for the weighted average cost of capital. The WACC represents a blend of costs of capital across all sources. The sources include common shares, preferred shares, and debt. Its percentage of total capital weighs the cost of capital and then is added together. The WACC is a mashup of debt and equity and its weights, and many use the WACC as a discount rate for financial modeling. The WACC also acts as a minimum expected return in a discounted cash flow and other valuation methods, such as a dividend discount model and an excessive return model. The WACC includes in its formula beta, equity risk premium, risk-free rate, and average yield of debt, taxes. As we can see, WACC takes elements of your investment's equity or risk and the impact of debt and its interest payments. The formula for WACC is below. WACC equals E/V times RE plus D/V times RD multiplied by 1 minus T. And the inputs. E equals market cap. D equals market value of the company's debt. V equals total value of capital, equaling equity plus debt. E/V equals percentage of capital that is equity. D/V equals percentage of capital that is debt. RE equals cost of equity or required rate of return. RD equals cost of debt or yield to maturity on existing debt. T equals tax rate. The purpose of WACC is to determine the cost of each part of the company's capital structure based on the portion of equity, debt, and preferred stock. Each component of the formula has a cost to our company. Each company pays a fixed interest rate on its debt and preferred stock. Even though a company doesn't pay a fixed rate on its equity, it may pay dividends in cash to its stockholders. The WACC remains an important piece of the DCF model and an important concept for everyone to understand, especially if you try to value companies. What is ROIC? An overview. On the other side of our comparison, we have the metric ROIC, or Return on Invested Capital. The ROIC is a profitability or performance ratio that measures the percentage return a company earns on invested capital. The ROIC tells us how efficiently a company uses the investor's monies to generate income. Companies like to use ROIC as a benchmark to calculate competitors' value. We calculate ROIC by taking the cost of investment and the returns generated from that investment. The returns are all the earnings after taxes, but before interest payments. We calculate the investment by subtracting all current long-term liabilities from the assets. The investment cost is either the total assets required for the business or the amount of financing raised by debt or equity sales. Next, we divide the return by the cost of investment. Return on invested capital, or ROIC, equals net operating profit after tax, or NOPAT, divided by invested capital. A note: NOPAT is also equal to EBIT, multiplied by 1 minus the tax rate. Okay, let's look at the differences between WACC and ROIC. What is the difference between WACC and ROIC? The whole point of analyzing financials is determining if the company's assets generate returns that exceed the cost of funding those assets. And the next question, once we determine those returns, will those excess returns continue? The answer to the first question lies in the past, thus analyzing the company's assets and earnings or cash flows those assets generate. That is the essence of the return on invested capital formula, to measure the assets and their impact on earnings. To give you a simple example of why this is important, See's Candies, from Buffett's initial investment, grew from $4 million in earnings to $27 million on assets of $17 million. See's earned $27 million on $17 million of employed assets, or 150% return on invested capital. Not too bad. So, what does WACC have to do with this? Plenty. The WACC is a measurement of the cost of debt and equity expressed as a percentage, which tells us how much we should expect in return for investing in that company. Because both formulas look at the cost of equity and debt, they tell us how much those costs equal the rate of return we should expect. But if the ROIC is greater than the WACC, the company is creating value because the company is investing in value-creating projects. Yet, if the ROIC is lower than the WACC, the company is destroying its value because the projects it invests in are lower than the cost of funding that project. Final thoughts. As Buffett mentions, you look for businesses that create more value with their projects than destroy them. The basic idea is that ROIC tells us how efficiently the company generates greater returns than its cost to create those returns. When analyzing any company, the first item to investigate is the return on invested capital. We want to find higher returns on invested capital from each company we analyze, but not every company or sector will equate apples to apples. Comparing the ROIC of Apple to Walmart doesn't offer a fair comparison because of the nature of each company's assets. Also, comparing Microsoft to Apple is not a great comparison. However, comparing Intel to AMD, Walmart to Target, or Wells Fargo to Bank of America is far more reasonable. A company with an ROIC less than its WACC doesn't make it a poor investment now. If the company attempts to rid itself of its non-performing assets, it might have a bright future. It is always best to think through the investments and understand the reasons for management's decisions before acting on them.